Hi everybody, this is Joseluiz Morales. Welcome back to the Morales Group Show. Today I am going to be sharing with you guys a story of how I purchased my first property and how I was able to turn an $8,000 investment into $600,000. So stay tuned. So I know what you're thinking. You're probably thinking like, how did this guy turn an $8,000 investment into $600,000? It doesn't make any sense. It's not possible. Nobody can turn an $8,000 investment into $600,000. So in this video, I'm going to share with you exactly what I did to turn an $8,000 investment into $600,000. And I'm also going to share with you some of the lessons that I learned along the way in terms of mindset that allowed me to do this and things that I learned along the way that helped me to achieve this outcome. So it all started back in 2010. I had graduated from Cal State Northridge. At that time, I was under the impression that I had to basically have work experience of 2 years to be able to qualify for a loan. However, I was able to speak with a loan officer, which is key. And the loan officer was able to coach me and tell me that essentially if you get a job after being a university graduate in the same industry that you basically graduate in, that essentially it waives a 2-year minimum requirement and that essentially you can qualify for a loan immediately. So it was perfect because obviously I didn't want to have to wait that 2-year requirement. I didn't have the 2 year of job experience. And I felt at that time that the real estate market was a good place to be. So essentially in 2009, I graduated from university. I was able to buy my first property in 2010. I didn't wait the 2-year requirement. And essentially I bought through a program called FHA. Now, FHA is a program for first-time homebuyers where they allow you to purchase a property with a minimum of a 3.5% down payment. The only requirement is obviously that you have to live in the property, which I did. We were in the middle of the real estate crisis. So essentially prices were slashed in half. Prices were a third of what they are now. However, there was a lot of fear in the marketplace, meaning people were scared. People didn't want to be involved in real estate. There's a great quote by Warren Buffett that says, "Be greedy when people are fearful and be fearful when people are greedy." So essentially at that time, there was people saying, don't buy a house. Essentially, they're going to keep dropping. I had one particular family member tell me that there was a lot of shadow inventory that was going to be coming in the real estate market and that I should be concerned and that prices were going to continue dropping. However, I like to look at things from a logical perspective. What I mean by that is at that time, at a purchase price of $250,000 with a minimum down payment of 3.5%, my mortgage payment was $1,700. So the way that I looked at it is I said, if I ever want to move out of this house, how much could I rent it out for? And at that time, the rent was $1,900. So I told myself, I was like, I don't care if the marketplace drops. I don't care if prices continue going down because I'm not the type of person that tries to time the market. What I mean by that is that I don't think that I'm smarter than the marketplace, meaning that I don't think that I've got this special skill or knowledge where I know where the bottom is going to be. My philosophy is always, if the opportunity makes sense or if the numbers make sense, who cares if the market continues to drop? Who cares essentially if prices continue to go down? Because as long as the property cash flows, essentially you're protected whether the marketplace goes up or the marketplace goes down. So essentially, after a year of living at the property, I ended up renting out the property. So I ended up renting out the property for 3 years. I wasn't making much money. Essentially, I was making $200 a month. However, for the amount of money that I invested, it was a great return. What I mean by that, $200 a month times 12 is $2,400 a year divided by the $8,000 investment that I made. It's approximately a 30% return. So my return on investment was great. However, during those 3 years, I noticed that prices had gone up substantially. The property that I bought at $250,000 was now worth $350,000. So I did a calculation called return on equity. Now, this is different than return on investment. This is basically how much are you receiving based on the equity that you have in the property? Because that money has an opportunity cost, meaning could I put that money elsewhere and earn a better return? So essentially, when I did the return on equity investment at $200 a month times 12, that's $2,400 a year, divided by $100,000 that I now had in equity, I was earning approximately a 2% return on my money. So I said, based on the investment, I'm earning a great return, but based on the equity that I have in the property, I'm receiving a horrible return. So essentially what I did is I started to look for different opportunities to see if I can move the same $100,000 that I had in equity, to see if I can move it somewhere else where it would earn me a better return. Sure enough, I came across a fourplex property. This fourplex property was more expensive. It was only $405,000 at that time. However, it was 4 different units, so I was able to bring the amount of money that I was collecting substantially higher. So I went from collecting $200 a month on a $100,000 equity to collecting $2,000 a month of positive cash flow on a $100,000 investment on the fourplex. So I went from $200 a month positive cash flow to $2,000 a month. So that's $24,000 a year. And that's on the same $100,000 in equity. I think it's like a 20-something% return, maybe like 24% or something like that. So essentially, the lesson there is that although it may be a good return on investment, sometimes whenever you calculate the return on equity, there may be a better place for you to put your money. I do this analysis for my clients all the time. What I mean by that is that sometimes people think that they're earning a great return. They're like, yeah, I'm making $600 of positive cash flow a month. I'm making $1,000 of positive cash flow a month. My first question is always, how much equity do you have in the property? And sometimes I hear things like, oh yeah, I'm making $1,000. I'm like, how much equity? They're like, well, I have $500,000 of equity. And I'm just like, man, that's a really low return. I do the math and it's like an extremely low return. And I asked him, I said, could we take that same money, put it somewhere else, maybe like a triplex, a fourplex, a 10plex, a 20plex, and earn you a better return than the $1,000 that you're making? And a lot of times when they're in a property, I could help them do that. Now, here's what I also tell clients. Sometimes a good primary residence, what you look for in a good primary residence is different than what you look for in a good investment. So sometimes renting out a primary residence with an HOA or something that is in a super nice neighborhood may not be the best rental property. So we're able to analyze that for clients as well too. But regardless, let me get back to the story. I make $2,000 a month, $24,000 a year. I've been making that from 2014 to 2020. Essentially, that's approximately about $150,000. Not only that, but that property has essentially increased in value. So if we take the basis that I purchased the first property at $250,000, now this fourplex is now worth $700,000. That's a $450,000 difference. Now, on top of that $450,000, I received approximately $150,000 in positive cash flow over the amount of time that I bought the first property to now. So essentially, when you add those two things up, it adds up to approximately a $600,000 return on that investment. So when you look at it, essentially you turned $8,000 into $600,000. So essentially the lessons are here. Number one is nobody can time the market. I mean, there's people that think that they want to be able to time the market. That's not the philosophy that I have. I don't try to time the market. I'm a logical person. If the numbers make sense, then I do it. Regardless of what's going on around me, regardless if people are saying the market's going to crash or whatever, I do the numbers. And if the numbers make sense based on a cash flow perspective, then I pull the trigger. The second lesson would be to talk to your loan officer. A lot of people think that they don't qualify for a loan, but essentially they might be surprised and they might qualify for a loan because there may be a program out there that is perfect for them, just like there was that program for me where I was able to qualify without having the 2-year job experience. The third lesson is that essentially there's something called a 1031 exchange where you can sell an investment property and defer any of the gains, meaning you don't pay any capital taxes on the gain as long as you buy something of equal or more value. The last lesson is don't be scared to make an investment. Essentially, do the numbers, and if the numbers make sense, pull the trigger. And essentially, if you ever need any advice on what to do, how to analyze a property, I'm happy to run that for you. That's what our company does, Morales Group. We're happy to run that analysis for you. So I wanted to say thank you so much for watching this podcast. This is an episode of the Morales Group show. If you've enjoyed this, please subscribe, please like it, and please share it. It helps the YouTube algorithm. And then lastly, you might see a couple of videos above or below. Feel free to watch one of our other podcast episodes. Once again, Joseluiz Morales. I'm with the Morales Group, and I'm happy to help you in any way, shape, or form that we possibly can. Make it a great day, and thank you so much. Bye-bye.